Everybody in America has an opinion about your 401k, and most of them are trying to scare you out of the single most powerful retirement account you have. You've heard it. Don't lock your money up in there. The early withdrawal penalty is a trap. And then the big one. When you retire and start pulling that money out, the taxes are a bomb waiting to go off. Two fears. And those two fears keep millions of Americans from ever fully using the traditional pre-tax 401k and IRA. So today, I'm going to do something different. I'm going to take both of those fears, put real numbers on them, and diffuse them one at a time. Because when you actually run the math, that so-called tax bomb usually turns out to be a tax discount. Stick with me, because by the end, you'll never be scared of this account again. First, let's remember why we're even talking about this account, because people forget how good it is. A traditional 401k or IRA is pre-tax. Every dollar you put in comes straight off the top of your taxable income for the year. You contribute, and you are not taxed on that money now, while you're working and sitting in your highest earning years. Then it grows for decades without the IRS taking a cut along the way, and you only pay tax when you pull it out in retirement. So think about what that really is. It's a deduction today, tax deferred, compounding for 30 years, and a tax bill shoved way out into the future, when you may very well be in a lower bracket. On top of that, a lot of employers hand you a 401k match, which is free money, an instant 100% return on your contribution. That is an enormous head start. And yet, people talk themselves right out of it because of two myths. So let's kill them one at a time. Myth number one, if I put money in there and then I need it early, the penalty destroys me. So the whole thing is a trap. Here's the real rule. If you pull money out of a traditional 401k or IRA before age 59 and a half, yes, you generally pay a 10% penalty plus ordinary income tax on the amount. That sounds brutal, but watch how fast that fear falls apart. First, this only bites if you raid the account early. If you just leave it alone until 59 and a half, the penalty does not exist. It's zero. The trap is something you would have to actively do to yourself. Second, even if you do need money early, America is full of penalty-free escape hatches, and almost nobody knows they exist. There's the rule of 55, where if you leave your job in the year you turn 55 or later, you can tap that employer's 401k with no penalty at all. There's a strategy called 72T or SEP, where you take substantially equal payments and skip the penalty completely. Then there's first-time home purchases, qualified education, big medical bills, the birth or adoption of a child, disability, and health insurance premiums while you are unemployed. All of those can dodge the 10%. The penalty is the default, not a life sentence. Picture someone who retires at 56. With the rule of 55, they can pull from their most recent employer's 401k penalty-free. Years before that 59 and a half line, everyone obsesses over. The rule you've never heard of is usually the one scaring you. And third, here's the part the fearmongers always leave out. You already got a tax deduction on the way in, and the money grew tax deferred the entire time. Let's say you're in the 22% bracket and you put in $6,000. That single contribution just saved you around $1,300 in taxes this year, and then it compounds for years. So even in the absolute worst case, where you pull it out early and eat the full 10% penalty, the deduction you already banked, plus all that tax-deferred growth, usually leaves you ahead of where you'd be in a regular taxable account anyway. So myth number one is mostly nonsense. The move is simple. Don't rate it for a vacation, and if you genuinely need the money, use one of the exceptions. Now, myth number two, the big scary one. When I'm old and I start withdrawing, or when required minimum distributions kick in, the taxes are going to be a bomb. This is the one that really keeps people up at night. And it is the one that completely falls apart the second you use real numbers. So let's use them. Picture a single retiree pulling $60,000 a year out of their traditional IRA, and that's their income for the year. In America, you do not get taxed on the whole 60 grand. First, the standard deduction knocks around $15,000 right off the top, completely tax-free. That leaves about $45,000 of taxable income. Then it climbs the brackets, 10% on the first slice, 12% on the next. And when the dust settles, the total federal tax is roughly $5,000. $5,000 on $60,000 of income. That is an effective tax rate of about 8 or 9%. Let that sink in. You very likely deducted those contributions at 22 or 24% while you were working, and now you're paying the bill at 8 or 9. That is not a tax bomb. That is a tax discount. You won the arbitrage. Okay, Sal, but what about the people pulling out way more than that? Fair. Let's crank it all the way up to a retiree pulling $120,000 a year. Even there, after the standard deduction and running up through the brackets, the effective federal rate lands somewhere around 15%. $120,000 a year in retirement, taxed at about 15%. That is still lower than what most working professionals pay on their salary today. Still not a bomb. And those required minimum distributions everyone dreads? All an RMD means is that starting at 73, the IRS finally makes you take some money out, so it can collect the tax it patiently waited 30 years for. It is not some extra penalty. It's just the bill for a party you already enjoyed, and you can shrink it years in advance. Now, what about the health insurance angle? IRMAA, that thing where a high income drags up your Medicare premiums? It's real. But here's what they don't tell you. IRMAA doesn't even start until your income is up around $106,000 as a single person, or over $200,000 for a married couple. The everyday retiree living on $50,000, $60,000, $70,000 a year never even touches it. And the taxation of your Social Security benefits, also very manageable and something you can plan around by controlling which accounts you pull from and when. And that word, control, is really the whole secret to myth 2. You decide when and how much to withdraw. You can do Roth conversions in your low income years, early in retirement, to shrink those future required distributions before they ever start at 73. After 70 and a half, you can give directly from an IRA to charity and skip the tax on it entirely. You are not some helpless victim strapped to a bomb. You are holding a dozen levers. So here's the verdict. The traditional pre-tax account is not a trap. It's a tax timing machine. You take the deduction at your highest rate while you're working, and you pay the bill at your lowest rate in retirement. And plenty of people retire to a state with no income tax at all, or one that doesn't tax their retirement withdrawals, which quietly shaves that bill even further. That's the whole game, and for most people, it's a winning one. Now, I've made entire videos about the Roth, and I love the Roth. Tax-free growth, no required distributions, and it doesn't spike your IRMAA or your Medicare premiums. If you genuinely believe your tax rate is going to be higher in retirement than it is right now, the Roth wins. But please, do not let Roth hype scare you into throwing away a fat deduction today. For most Americans who will be in a lower bracket later, that traditional deduction is pure gold, and the tax bomb story is a myth built to make you feel smart for walking away from free money. Now, the honest part, because I'm not here to sell you a fantasy, none of this works if you don't actually fund the thing. Maxing out a 401k and an IRA is real money, and it takes years of boring, relentless consistency to build a balance big enough to retire on. You are not getting there in a couple of good months. You get there by contributing every single paycheck, letting that deduction cut your taxes now, and letting decades of tax-deferred compounding do the heavy lifting. And if your employer offers a match, turn it on today, because skipping it is leaving a guaranteed 100% return sitting on the table. Then just don't touch it early and let the arbitrage quietly work in your favor for 30 years. So the next time somebody tells you your 401k is a tax bomb, you'll know better. It's a deduction now, growth in the middle, and a discount at the end. If this cleared up the fear for you, do me a favor and smash that like button so it reaches more people who've been scared off the best deal in American retirement, and hit subscribe. And since these brackets and rules change every single year, always check the current numbers before you make a move. I'll see you in the next one.